Hey, how's it going everyone? My name is Griffin, and in today's video, we're going to be covering a ton of information about how you can start investing confidently in the stock market with as little as $100. Now, this is going to be a relatively long video, so make sure that you bookmark it right now so that you can revisit it at a later date to get you back up to speed with what we'll be speaking of, as we're going to be covering a 30-slide presentation deck that I'll make downloadable in the description if you're interested. Let's get into it. Okay, so $100. This is a great starting point for any new investor. Reason being, $100 isn't necessarily all that hard to come by, and the concepts that we're going to be learning about in today's video apply to investing $100 just as much as they apply to investing $10,000. So over time, as the value of your portfolio grows and you make more income, all of this information is still going to be highly applicable in the exact same way. And $100 is also just a great amount to get your feet wet in the world of investing and to start fostering more of an investor mindset where saving and investing money will be more top of mind over time. All right, so on the title slide here, we're of course going to be learning about how to invest your first $100 in the stock market as a beginner. And by the way, if you want to check out a more in-depth training, you can check out my 7.5-hour completely free course over on Skillshare that now has over 1,500 students in it and great reviews. Moving into the second slide now, this is what we're going to be learning about in today's video. So we're going to be covering a lot of things today, including what to do before you start investing, why you need to start investing today, what are stocks, 2 different ways to build wealth in the stock market, what is the market capitalization of a company. Following that, we're going to be speaking about types of stocks, categories, and sectors, because these are all very different in the world of investing. What can you buy as a stock market investor in terms of financial vehicles? Because actually there are more than just stocks that you can invest in. There are different types of financial securities that we'll be speaking about. Following that, we'll be speaking about financial documents in the process of researching stocks, financial ratios used to evaluate a stock, followed with different types of accounts that you can open and invest in. So I'm not going to go through everything else, as we can see a lot to cover today, including even a full walkthrough of buying and selling a stock using a discount stock brokerage. So enjoy today's video and please leave it a like if you get any value from it. That is all I ask in return. Also, as mentioned at the beginning of today's video, you will be able to download this presentation for free if you'd like. I'm going to leave a link down in the description. And while you're down in the description, you can get some free stocks and cash for signing up to one of the brokerage accounts that we'll actually be covering in today's video. But with all of that said, let's get right into it. Okay, so it might be really exciting to want to start investing in the stock market, jumping headfirst into opening up a brokerage account and buying your first stock. But before we do that, there are a couple of steps to take into account. They'll go pretty quick though, so right here, before you start investing, the first thing to concentrate on is always going to be eliminating any financially crippling high interest debt balances that you might be carrying and paying interest on currently. This, in my opinion, all needs to be eradicated before you start investing in the stock market. So I'm speaking about things such as credit card debt, potentially some personal lines of credit, and pretty much any other type of line of credit that is going to be above 5 or 6% in annual interest. Reason being is that when investing capital, typically speaking, over time, the broad stock market is going to yield annual results of around 8 to 10% on average. However, this is not going to be the case every single year. So by eliminating high interest debt at, again, 6% or more, let's say, you're instantly saving on a 6% return that you would be otherwise losing out on in the market. Another way of putting this is if you have a credit card balance, that's a 25% annual interest rate that you're paying on your balances, where you'd have to be able to create a 25% return in the stock market consistently to even just break even on the interest that you're paying on your credit card balance. So eradicating all that debt is the number one step. Once you have your debt under control, step number 2 will be saving up an emergency fund of anywhere from 3 to 6 months worth of expenses. And we speak about this a lot on the channel, so I'm not going to spend much time on it here, but basically, in my view, having savings that are outside of the market fluctuations, not impacted by the general stock market, is always the wisest thing to do when you're first starting out and looking to invest. So if anything happens, say to your job, there's a market downturn, whatever that might happen that's out of your control, well, you have some savings to live off of temporarily. Now, the good thing is that during this process of eliminating your debt and saving up that emergency fund, you can learn all about financial literacy as much as possible, which will pay dividends your entire life anyways. And what's more is that right now, at the time of filming this video, interest rates on most high interest savings accounts hovers in the 4 to 5% range for a good high interest savings account, which is actually a decently nice return for having your cash just sitting in a bank account anyways. And then finally, before you start investing, you need to foster a long-term and consistent mindset towards your investments. This video isn't about, day trading or trying to create short-term gains in the market, which typically ends up with short-term losses anyway. So a long-term approach to building wealth through your investments is the way to go for more consistent returns over time. All right, now from here, why exactly should you focus on trying to invest as soon as possible once you have that debt and your savings under control? Well, there are 2 primary reasons for this. The first one, and most evident, is that investing is going to help you build wealth over time. Everyone wants to make more money and create more income streams, right? So investing in the stock market is one of the easiest ways that absolutely anyone can start, as I said earlier, even with as little as $1 or $100. But in this case, let's say with $100, where you can start investing and building your wealth while crafting your investor mindset with very little money to begin with, as opposed to other asset classes like real estate that typically require tens of thousands of dollars to start. And paper assets such as stocks and other financial securities that we'll actually be covering in today's video are historically some of the best tools to build wealth over a long time frame. In fact, historic averages in the stock market, at least the American stock market, are around 7 to 10% annually. And this is quite good because, again, over a longer period of time, as you stay invested in the market, you'll be tapping into compound interest and other forms of exponential growth that we'll be speaking about shortly. Additionally, in the 21st century, as opposed to investing in, let's say, the 1980s or when our parents were investing, we have lower fees than ever with some of the financial vehicles and brokerages that are available to us today that were not available to us even 10-15 years ago. For example, we have access to exchange trade funds that have quickly become some of the most popular financial vehicles available that have very low management fees. And when it comes to actually trading individual stocks, we now have discount brokerages offering near zero commissions on all trades. So there are literally no excuses to not be investing in the stock market as of right now. Following that point, there is now an extremely low barrier to entry where everyone can start investing from the comfort of their home directly on their mobile phone. And we also have much wider access to different investment vehicles, whereas in the past, individuals who were interested in investing had to be quite a bit more hands-on with their investments than some of the options that are offered today. The second main reason why you need to start thinking about investing today is because investing is going to be a great hedge against inflation. Inflation is something that I'm sure everyone has heard quite a bit of in the news recently, as we're seeing very high levels of inflation that are impacting our everyday spending. Essentially, what it is every single year, things pretty much just become more and more expensive. So that's why back in the day, you could buy a brand new car for, say, $10,000 $1,000 or even less. And now a brand new car is probably going to run you at a minimum 30 grand depending on the model. So if you just hold cash in a cash account every single year, despite, current interest rates in high interest savings accounts being okay at 4 or 5%, well, its buying power though of this money sitting in the account is being eroded away, and you can essentially just buy less with the same amount of money. However, on the flip side, if you're investing and trying to create a return on that investment every single year, you're able to at least counter some of inflation's effects on your cash's buying power. That is really the goal of investing, other than building your wealth. So as mentioned earlier, on average, cash loses value every single year. It's pretty small, but up here I added a little image about the value of cash over time as more and more money has been printed by the central bank. It has gone down in value by almost 95%, which is staggering to think of. Now that I hopefully have you convinced about the power of investing and why you need to start investing as soon as possible, let's actually speak about what a stock even is in the first place, which might sound really simplistic, but quite a few people may still actually have a hard time grasping the concept. So quite simply, a stock is partial ownership in a publicly traded company. It's important to note here that not every single company is a publicly traded company. You might go down to your local mall and see a company or a shop that is a private company. And so in that case, its ownership is not going to be traded on a public stock exchange like a publicly traded company will be. And outside investors cannot freely buy and sell shares of a private company that, again, doesn't trade openly on the market. But in the case of a public company, like in this example, the fictitious company Griffin Public, ticker symbol GTM on the TSX, well, let's say that this company had 10 equal shares out in the market. Every public company has what's known as shares in circulation, by the way. So in this case, we're just going to bring it down to a much smaller scale so that it's easier to grasp. Let's say this company had 10 equal shares. If you were to own 2 shares of this company, well, you would essentially own 20% of Griffin Public. And the reason why public companies issue out stock in the first place or become public is to raise capital to fund the growth of their operations. Issuing out shares and therefore giving out equity of the company is one of the most popular ways for a company to raise more capital. An alternative is to take on more debt to fund operations, but these are the 2 main ways that a company can raise capital. Now, shares of a company's stock will trade on what's known as a stock exchange. In Canada, the main exchanges include the Toronto Stock Exchange, acronym TSX, and we also have the NEO Exchange, the Canadian Securities Exchange, which is the CSE, and the TSX Venture. In America, the main exchanges are the New York Stock Exchange, the NASDAQ, the BATS, and a couple more. But with the concept in mind of what a stock even is, well, a public company's value is also known as its market capitalization, or for short, market cap. A company's market value is going to be constantly changing as shares exchange hands in the open market, essentially as traders are buying and selling shares. So it's sort of like an auction house, and depending on the offer and demand for a given position, well, a share's value will rise or decrease in value. So this is why a publicly traded company's market cap, other name for company value essentially, can fluctuate greatly even in one single trading day. In fact, the market capitalization is calculated by taking the market price of one single share of the company and multiplying that by the amount of shares that are out in circulation in the market, which is going to be different for every single public company, by the way, as every publicly traded company has a different amount of shares out in circulation. Now that we understand what stocks are at their core, let's now speak about how how in the world of investing, stocks are categorized as different types of stocks based on their characteristics. So of course, there are thousands of stocks available to buy in the public markets, and for this reason, stocks are categorized differently based on multiple different elements. And these are only a couple of the different types of categories of stocks. First of all, we have what's known as the growth stock. We also have the dividend stock, value stock, and then also cyclical stocks. Again, there are more categories, but these are the four main types of stocks in the stock market that you'll find. Now, from here, we can also have a mix of different types of stocks. For example, we can have a dividend growth stock or a value dividend stock. These are types of categories that can be created based on the characteristics of a given company and the stock in question. Growth stocks tend to command higher valuations than other types of stocks because typically with a growth stock, expectations for their growth is much higher. So for this reason, investors are generally willing to pay more for the company's current level of revenues and underlying net income. This is why the valuations on growth stocks are generally higher than some of the other types of stocks we'll be covering. Now, a growth stock is categorized by rapid expansion of operations for the underlying company in question, which is why a growth stock can offer quicker capital gains usually than other types of stocks from a fundamental standpoint. Because let's remember, under the hood, a stock is attached to a company. Now, this is also a company that generally is going to be reinvesting as much of their earnings as possible and even potentially taking on more debt to fuel this growth at a much quicker pace. These companies, for this reason, don't generally pay out dividends because they are using as much of their capital that they have on hand and at their disposal to just reinvest back into further levels of growth. Maybe developing new product lines, entering into new markets, competing with other businesses in some geographic markets, or certain industries. These are all things that a growth stock is characteristic of. Now, as a result of everything that we just spoke about regarding a growth stock, these will generally have the potential for higher returns in a shorter period of time over other types of stocks. But this inherently comes with generally a higher level of risk as well. Always remember that in the stock market, a higher level of potential growth generally comes with a higher level of risk and volatility as well. So clear-cut examples of a pure growth stock right now in the market would include Nvidia, for example, or Tesla. All right, now the second most popular type of stock available in the market that we speak of a lot on this channel is the dividend stock. And quite simply, pretty much any company that pays out a dividend can be considered to be a dividend stock. This is why if a company that pays out a small dividend but also has huge capacity for growth can quickly become a dividend growth stock. And if that company is paying out dividends increasingly over time, this is even more beneficial for the investor. So like I said, a dividend stock pays out distributions to their shareholders. And what distributions are basically just cash payments that a company is paying out and distributing to their shareholders simply as a reward for holding the stock in the first place. Now, since distributing dividends generally requires a good amount of net income and profits, these tend to be blue chip companies that are well established in their industries and have more consistent levels of revenues as well as net income and cash flows to sustain their dividend payments out to shareholders. So a dividend stock's yield, which is something that you will hear about quite often in the world of dividend investing, and even on a company's quote, gives investors a good idea of what a dividend's current return is in parallel to the current market price. So a dividend yields calculation, or the formula, is the dividend that a company is paying out per share in a year and dividing that by the current market price. Dividends are typically paid out on a quarterly schedule, so every 3 months, but a company can choose to pay out their dividend at any schedule that they choose to. It can be monthly, it can be quarterly, biannually, or even annually. But again, the most common schedule is on a quarterly basis. Now, finally, a dividend stock is a good way to compound the growth of your portfolio over time, as well as creating a new source of income for yourself. So if you choose choose to take in the dividend payment that you're receiving from your stocks and reinvest them back into the growth of your portfolio by either buying more of that dividend stock or other stocks, this will over time have a compounding effect and will lead to the exponential growth of your portfolio. Some examples of great dividend stocks include Fortis Incorporated as well as TD Bank. The third most common type of stock is what's known as the value stock, which is a type and category of stock popularized by investors such as Warren Buffett, who I'm sure you're well aware of. A value stock doesn't necessarily have any clear-cut characteristics like, for example, what a dividend stock is, where if a company pays out a dividend, automatically it's a dividend stock. In the case of a value stock, it's a bit more subjective to the investor in question because a stock that is considered to be undervalued in any respect could be considered to be a value stock. So I'm speaking about undervalued in regard to the current financials in relation to the current market price. In a higher valued market or expensive market, like we've seen over the past couple of years, where the average stock is commanding a much higher price to earnings ratio than previously in the stock market, well, value stocks can be harder to come by and will require quite a bit more research to uncover a stock that is showing value relative to potentially itself in the past, as well as in relation to other peers in its industry and even the market in general. Do remember that the market price of a stock that is publicly traded fluctuates all the time and is dictated by what investors are willing to pay for that stock at any given moment. So for this reason, a stock's current market value, when you go and search up the value of, say, Apple stock, doesn't necessarily mean that it is actually fundamentally worth what people are willing to pay for it right now. This is where value investors try to seek out stocks that are trading for what they believe to be significantly less than what the market is currently paying for it. Now, you might be wondering, why would a stock be trading at an undervalued level to what it is truly worth? And there are multiple different reasons for this. So it's impossible to pinpoint one given reason, but there are both qualitative and quantitative factors that come into play with how the market values a stock. By quantitative, I mean things like negative investor perception of a stock or its outlook over time, as well as short-term, maybe negative press and company earnings. Company earnings would be a quantitative element though. So all of this is taken into account and the market sort of dictates what they're willing to pay for the stock at any given moment. Considering what we just spoke about, there are two main wealth building elements when investing in the stock market. The first one is dividend income. Instantly, when you hold dividend stocks, you're creating a new source of income for yourself. And these dividends, like I said earlier, can be reinvested for faster compounded growth like we see in this chart. And the second wealth building element is called capital gains. This refers to the actual appreciation of the asset's value over the course of time that you're holding the company's stock. So essentially appreciation of share value over time. And this will organically occur over an extended period of time as a company excels from a financial standpoint. If a company over a 10-year period has 10x their revenues and their underlying earnings, generally speaking, the actual price of its shares will follow suit. Now, taking it one step further from the stock types that we just looked over, stocks can also be categorized into various different categories in regards to their market capitalization. So the size of the company in question. We have large cap stocks, mid cap stocks, and small cap stocks. We'll start with large cap stocks. Now, these are companies that will have a market capitalization of $10 billion or more. There are hundreds of companies in this $10 billion mark, and some companies are even exceeding the $1 trillion mark as of today, which is completely mind-blowing. But a large cap stock is going to typically be more of an established company. So a company that's been around around for a while. They have a really good customer base, and for this reason, their revenues have been able to, at the very least, stay steady and consistent over the past couple of years, if not growing year over year at a consistent pace. They will, however, generally provide a slower and steadier return in regards to share appreciation. Now, keep in mind, none of this is concrete and set in stone though. A large cap stock can show massive appreciation in a 1-year time frame, as we've seen recently with mega cap stocks in the American telecommunication and IT sector. But as a rule of thumb, usually a larger cap company, as a result of the fact that they're already established, will not grow at the same level that potentially a mid cap or a small cap stock will. That said, they have a higher likelihood of paying out a dividend, reason being what we just spoke about. They have more consistent revenue and cash flows. They can generally pay out or afford to pay out a more consistent dividend. But of course, that is not set in stone or guaranteed. A mid-cap stock is a company that will have a market capitalization between $2 and $10 billion. And these can be sort of a happy medium between the larger and the smaller cap stocks, representing both growth but also stability. Now, these could provide quicker returns than large cap stocks, but also these are companies that are generally going to be in the process of expansion, but aren't still a small company that's still in hyper growth phase. And small cap stocks have a valuation between $300 million and $2 billion. These are companies that are reinvesting as much of their capital into fueling growth of their own company. And for this reason, generally will provide investors with higher levels of return in a shorter period, but this can also come with much more volatility and risk. A small cap stock can also potentially be more sensitive to the downturn in the economy or different ebbs and flows of the market, because generally these are companies that will have much smaller balance sheets with less cash on hand and fewer assets at their disposal to utilize and liquidate if they ever need to utilize higher levels of cash to sustain their operations and continue fueling their growth. All right, so we know that stocks are simply shares of companies. So of course, different companies operate in different industries. Not every company is going to be, say, a utility company. So all of these stocks are categorized into sectors as well. And for this reason, certain index funds that we'll be speaking about shortly will maybe categorize certain stocks into these different industries and create funds around different sectors. So common sectors for stocks include utilities, energy, healthcare, travel, materials, industrials, consumer discretionary, which are basically consumer goods that are non-essential. Then we have consumer defensive, which are essential products, right? Toothpaste, food, and all things of that nature that need to be purchased regardless of the economic situation we find ourselves in. We also have information technology. This is everything including Apple, for example, high tech, different internet companies. All of that is grouped into information technology. Then we have telecommunications with, say, companies like Rogers, Shaw, AT&T, and then finally banking and finance. All the big banks as well as insurance companies and financial firms. All right, so we're moving very nicely in the presentation, and I hope that you're enjoying it and finding value so far. If you are, please consider leaving a like on the video. That's all I ask in return. Now, at this point, what are some different financial vehicles that as retail investors we have at our disposal? Because even though it's called stock market investing, there are more and different types of financial vehicles that we have access to other than just simple stocks. So of course, we do have the individual stocks, but there are many more, including mutual funds, exchange traded funds, real estate investment trusts, acronym REIT. You can also purchase bonds, real estate, precious metals, and cryptocurrencies. Real estate, precious metals, and cryptocurrencies, though, these are all assets and or commodities that are not necessarily directly traded on a stock exchange, such as all of the other ones like REITs, ETFs, mutual funds, and individual stocks. Let's dig a little bit more into some of these different investment vehicles, starting with exchange traded funds, since we already have spoken in detail about what an individual stock is. So quite simply, an exchange traded fund, acronym ETF, is a basket of stocks and or other securities that are grouped together into one single holding that seeks to track a certain sector or facet of the market. For example, 15 stocks that are all grouped up into one fund, and then investors can purchase this fund in one single holding. And ETFs are traded and sold just like a stock on a stock market exchange. Now, ETFs can be both passive as well as active. If they're on the passive side, they're typically going to track a passive index fund. For example, the S&P 500, the NASDAQ 100, or any other number of the dozens upon dozens of index funds available. If an ETF is on the active side of things, though, they can be actively managed. So in this case, it means that there are actually fund managers that are hand selecting, picking, and choosing the different stocks that are in the fund and rebalancing them over time. But why exactly would an investor want to choose an ETF, and what do they have to offer? So first of all, an ETF offers instant diversification and exposure to all of the holdings within that fund. This is one of the main reasons why you would invest in an ETF in the first place. With one single holding, for example, you can gain exposure to all 500 companies in the S&P 500. And for this reason, instant diversification without having to yourself go out and pick and choose 20, 30, 40 different stocks to achieve that same level of diversification. Also, the fees associated with an exchange traded fund are what's known as the management expense ratio, acronym MER for short. And typically, management expense ratios for ETFs will be relatively low as opposed to the MERs or just fees associated with, say, a mutual fund, which is very similar in nature. I'm a strong advocate of utilizing ETFs to your advantage as a retail investor to build out a strong and solid financial foundation to your portfolio. I personally use multiple different passively managed exchange traded funds, like for example the S&P 500, as well as a NASDAQ 100 ETF. These are two ETFs that I see being beneficial for most retail investors. In fact, moving into the next slide, we have the passive S&P 500 ETF. I made it its own slide just because I think it is so valuable for most investors to invest in this type of fund over the long term for at least a portion of your portfolio. As stated here, it says for most retail investors, a solid base holding should be an ETF that tracks the S&P 500. This is because typically it will have very low management fees associated with the fund, and you're instantly gaining exposure to 500 of the largest companies in the United States. Now, on a historical basis, the average annual appreciation of an S&P 500 ETF is roughly 8% and compounded over time, which is extremely powerful. US options for an S&P 500 ETF include VOO and SPY ETFs. Those are the tickers, by the way, and great Canadian options include VFV, offered by Vanguard, and XUS, offered by iShares. And then finally, the last financial vehicle that we'll be speaking about in this mini course is the Real Estate Investment Trust, acronym REIT for short. Now, a real estate investment trust is quite simply a company that owns and operates income producing real estate. So this is quite simply a company that's going to hold multiple different properties, operate them, and then generate income from rental income. Now, REITs are known typically for higher levels of dividend distributions, and for this reason, a higher yield in question. And this is because a real estate investment trust by law is obligated to pay out roughly 90% or more of its net income back to shareholders in the form of dividends. I'm not going to get into all of the details regarding this, but typically a real estate investment trust will have a higher than average yield relative to other dividend stocks. Now, REITs can be a good and simple way to instantly hold and gain exposure to real estate in your stock market portfolio without having to go out and purchase physical real estate and manage it yourself. Now, when properly managed, real estate can be a fantastic asset to hold in your portfolio, and therefore an REIT can be a very stable as well as great asset to hold in your portfolio depending on the fund in question. Remember, all of these are individual companies, so it's very important to conduct research on the financials of each REIT. With that said, since they are typically made up of hard assets though, real estate, well, this is going to generally have slower levels of growth over time. This is not always the case, but this is generally more indicative of a real estate investment trust's growth. Moving on, let's now speak about brokerage accounts. Now, this might be news to you, but you actually cannot purchase and hold stocks, ETFs, or any other financial vehicles that we spoke about previously in your typical bank account. You actually need to open up what's known as a brokerage account. And a brokerage account is what's going to allow you to hold, buy, and sell these different financial securities. Now, there are two main categories of brokerage accounts for investments. The first one being a non-registered investment account, and this will include cash investment accounts and margin accounts. The cash investment account is simply the most bare bones type of investment account that you have at your disposal. You can buy and sell all these different financial securities, and there are no tax sheltering benefits whatsoever. A margin account, which by the way, some brokerages will just call their cash account, automatically a margin account is basically the exact same thing, except with the margin account, you're able to access margin, which is another word used for debt. So you're able to take out a loan for investment purposes. Essentially, the brokerage can loan you out money to leverage up your funds in the stock market. This, by the way, is not something I would recommend whatsoever though for beginner stock market investors, but I thought I would still mention what it means. Now, the second type of investment account available is what's known as the registered investment account. In the United States, for example, we have the IRA, Roth IRA, and 401k, among a few others. Those are the main accounts. In Canada, we have the TFSA as well as the RRSP. There's also the RESP for child's education, but that's not typically something most investors will use when first starting out. So the Roth IRA and the TFSA, these are investment accounts that allow you to grow your money on a tax-free basis. Reason being, you're already paying taxes on your income in the year that you're making the investment deposits or contributions, and then you're investing after tax dollars. The IRA and the RRSP are sort of the opposite, where in the year that you're making the investment, the contributions count as a tax deduction in the year that you made the contribution. But then later on, when you withdraw your funds, this becomes taxable income. Both are very good options, and you should be utilizing both in an efficient tax strategy for your investments. I usually tend to recommend starting with the Roth IRA or the TFSA, but ultimately that is your own decision. And once you've decided on the type of account that you want to use, say the Roth IRA in the US or the TFSA in Canada, you need to use what's known as a stock brokerage to start buying and selling shares in the open market. A stock brokerage is basically a company that offers the ability to open up investment accounts and trade securities. And there are many different types of stock brokerages available. Most banks will have their own brokerage, for example, TD Bank, RBC, Charles Schwab, JP Morgan. All of these companies have their own investment brokerage houses. But then there are what's known as discount stock brokerage that have become highly popular in the retail landscape. Popular discount brokerages available in Canada include Wealthsimple Trade, Moomoo, and Webull. By the way, later on in this video, we're going to be buying and selling stock, and this will all be within Moomoo. Popular American discount stock brokerages include Robinhood, which most of you are probably aware of, Webull, and Moomoo as well. By the way, there are links down below in the description to some of these different discount brokerages where you can get some free money for signing up and making your initial deposit, no matter what the amount. All right, so at this point in the course, I want to walk you through buying and selling a stock on a platform. So we're going to be diving into Moomoo in this case and going over buying and selling a stock, as well as speaking about the stock's quote, different types of orders, research functionalities, and so forth. And although we'll be doing this within the Moomoo brokerage platform, keep in mind that pretty much everything that we're going to be looking at here is going to be applicable to any stock brokerage that you choose to go forward with. All right, so as mentioned, we're now going to be buying a stock within a stock brokerage so you can see how this process actually takes place. And for today's video purposes, we're going to be using Moomoo, which is a relatively new stock brokerage platform to the Canadian market. It's been available in the US for quite some time now, as well as internationally, but they've only just come to Canada and they have some great sign-up bonuses. So if you're interested, by the way, make sure to check out the link down below in this video's description. If you sign up using that link, you can get up to $1,500 worth of free cash coupons. But let's take a look at the platform. So right now we're in the watch list tab where I have, a couple different funds such as QQQ, which is the NASDAQ 100, SPY is the S&P 500, and then we have XIU being the TSX 60. From here though, we can go into the markets tab where we have lots of information about what's going on in the equity markets worldwide, in this case, from North America, Europe, even Africa and Asia. So a very comprehensive report and view of what's going on internationally on the markets, as well as in the crypto, bond, and Forex market. Now, in this case, what we're going to be doing is coming to the Canadian tab, because I just loaded $20 into the account just so I can show you how this process actually takes place. $20 Canadian, that is. So in the Canadian tab of the markets section, we can see both the TSX market, the TSX 60, and then even gainers and losers, a heat map, which is very interesting to see. Today, actually, the market is pretty much green across the board. And in fact, if we click on, say, oil and gas, we can then see a chart as well as other information relative to this industry within the Canadian market in question. So Moomoo has a lot of information and data related to the markets as well as individual securities, which is one of the reasons why it's a great platform that offers all of this free information, which typically you actually have to pay for. So in this case, we can see all of the top companies within the Canadian oil and gas sector, including Enbridge, Canadian Natural Resources, Suncor, and so forth. Clicking on, say, Enbridge here, we can once again see more information about the entire company. So profit ratio, support, resistance, as well as a trading overview, capital trend on a day, weekly, or monthly basis, and then news about the company and the company itself. So valuation, revenue, earnings per share, revenue breakdown, a lot of information that's really great to explore if you're someone who likes to research your own stocks. Now, if we wanted to purchase a specific position, all that's needed is to go into the search bar here and you can search the individual security that you're looking to purchase. In this case, let's say, for example, you wanted to purchase some NASDAQ 100 ETF, such as HXQ offered in Canada. As you can see right here, HXQ, it shows that it's in the Canadian market. We will click on that right here, and this is presenting us with this, in this case, funds quote, but this will be the same for both individual securities, so stocks as well as ETFs. This is what's called the quote. So up top we'll have both the name and ticker symbol of the position, as well as the price, market movements, and then other information such as the 52-week high, the 52-week low, historical high, and so forth. Now, in this case, it's not showing us the trailing 12-month dividend yield because it is a fund, and this is going to change periodically every time the individual dividend yield is going to change, because these are individual stocks held within the fund. But we can also see the position's stock chart over a 5-year, quarterly, daily, monthly, and weekly basis here. And the reason why there's a huge spike, by the way, is because this fund actually had a stock split a couple of years ago. Now, of course, depending on the stock brokerage that you choose to move forward with, there will be pros and cons to each one and different functionality available. But all of the base functionality that we just looked over in terms of the different order types, having a stock quote and stock chart, will pretty much be standard across all stock brokerages. Now that we understand what a stock is, the different types of financial securities available, and we've even gone over buying and selling a stock within a platform, well, it's still important important to learn how to actually evaluate a stock and ultimately know what you're looking at before buying. The research process of stock market investing is really important and paramount in the success of an investor over time. So when you're evaluating a stock, 3 main financial documents are critical for the research process. We have the income statement, which is a document that's going to give you information on things such as the company's revenues, their expenses, net income, and so on. And this is going to be both on a quarterly as well as on an annual basis for all of these documents, by the way. The next one is the balance sheet, which gives us information about a company's assets, their liabilities, and shareholder equity. And then finally, the third main financial document is what's known as the cash flow statement. In this one, we gain insight into a company's operating cash flows, their investment cash flows, financing cash flows, and then also their free cash flow figures, among others. Speaking about the most important elements to look for in each of these financial documents could be a full video series in itself. And actually, I did make that video series in my free stock market investing course that once again is available on Skillshare for free. So I'm going to be linking it down below in this video's description. You can check that out if you're interested. It would just be too long for today's video. However, we will be speaking about a couple financial ratios as quick ways to assess a company's current value in the market, along with some of its financial viability. So for example, some of these financial ratios include the price to earnings ratio, PE for short, the price to earnings to growth ratio, PEG, the price to book ratio, PB, current ratio, as well as the total ratio. These are all financial ratios used by investors to research and gain information on the company's current financials relative to market price. But we won't be covering all of them in today's video because it would simply be too long. We will, however, be covering arguably the most popular financial ratio used by stock market investors to quickly assess a stock's value in the market. It is what's known as the price to earnings ratio, acronym PE, as we can see here. And quite simply, the price to earnings ratio, what it does is divides a company's market capitalization by its net profits, its net income for the year. And there are 2 main types of price to earnings ratio. We have the trailing 12-month price to earnings ratio, which has the acronym TTM-PE, and this takes into account the financial figures over the past 12 months of the company. So again, the PE ratio formula just takes the share price of the company and divides it by the earnings per share over the past year, which is used to quickly evaluate the current value of a stock, and it can be compared to its own historic price to earnings ratio, as we can see up here in this chart that I included in the slide deck. And this is the price to earnings ratio for Apple stock over time. So right now we can see that it is very high compared to almost the past decade and a half, meaning it is commanding a higher price right now in the market relative to how much it's making in earnings over the past decade. We can also compare a company's current price to earnings ratio to the average PE of the industry that it operates in. In the case of Apple, it would be the information technology industry, and also comparing it to the whole entire market as a whole can be valuable. Now, a company can command a much higher price to earnings ratio if investors have high expectations of the company's growth in the mid to short term. However, you always need to ask yourself, well, am I paying too much for a company, right? A company that has a price to earnings ratio of 500 essentially means that it would take around 500 years for your investment to create enough net income to actually pay for itself. It's not as black and white as that, but that's essentially what it means. Dollar cost averaging and timing in the market. So dollar cost averaging is basically just the idea of investing consistently into the market smaller sums of money instead of one larger lump sum. So in this example, if you were to invest a lump sum of $8,000, well, this is just an example, but what they're showing here is that if the share price remains flat at $10 per share over time, your return over a period of time would be 0%. 8%. Whereas if over the same 8-month period, you were dollar cost averaging, so investing, say, chunks of $1,000 for a total amount invested of $8,000 at various different price points as the price of the stock or the ETF fluctuates because you're getting in at various different price points, well, this will give you a return of around 4%. Of course, this is just a fictitious example, but over time and historically, this has proven to be a really good way for the average investor to create higher returns in their portfolio. So regardless of if the market is up or if the market is down, consistency in your contributions is generally going to be the best course of action long term. Now, this is more easily accomplished with market funds and exchange traded funds, broader market funds that is, because you're consistently investing into these larger cap funds that are going to expose you to the growth of the entire market. Keep in mind that if we use historical data, it has always been better to stay invested in the market for the long term instead of trying to time the market at the best moment, entering and exiting the market at times that you think are opportune. This is usually going to work against you, trust me, and timing the market is actually impossible. Regardless of if you're Warren Buffett or whoever else, timing the market is practically impossible, and you might be able to attempt it and succeed once or twice, but doing this consistently over time is a complete wild card. So avoiding timing the market combined with consistent contributions is the recipe for massive growth of wealth in the stock market, because you're going to be taking into account and utilizing the power of compound interest, which will work to your advantage over the long term and help your portfolio gain that extra momentum. This is a clear example that I'm sure you've seen in the past, but it showcases from a visual standpoint the power of compound interest and why investing early and as soon as possible, starting today if you haven't already. Some of the next steps that I would recommend at this point, also if you're motivated to take your financial future in your own hands and start investing, would be to download this presentation so that you can reference the slides again, and then also bookmark this page so that you can come back and watch the video to get familiar with the concepts. Next up, open a brokerage account. It's super simple and only takes a couple of minutes, where you can use one of the links down below in this video's description to get some free money when signing up, or using the links directly in the presentation slide deck. And finally, you'll need to fund your account and start allocating some of your funds to core ETFs such as the S&P 500. So thanks a lot for watching and making it this far in today's video. I really hope you enjoyed it. If you did, make sure to give it a thumbs up. That's all I ask in return. And let me know down in the comments if you have any questions, as well as what are some of the things that you'll be doing this year in the stock market to improve your returns, or anything else for that matter. Thanks for watching, and I'll see you in the next one.